Failing banks, a dire situation. Beyond 2008. If you believe the 2008 global financial crisis was a thrilling experience, brace yourself for another exhilarating ride. The recent monumental collapse of the largest U.S. bank has sent shockwaves rippling through the entire economy. What implications does this hold for us? Could we be on the verge of a complete economic downturn? On March 10, 2023, the California-based technology hub, Silicon Valley Bank, SVB, faced a severe blow as state regulators forcefully intervened due to a significant decline in deposits. And as if that wasn't enough, just 5 days later, Swiss bank Credit Suisse suffered a massive blow when its primary investor refused to inject additional funds, resulting in a staggering 24% plunge in its share price. With these prominent banking institutions crumbling, it is evident that a banking crisis is already unfolding. How did we arrive at this point, and what are the implications for our future economy? Stay tuned as we delve deep into examining the contributing factors, the far-reaching consequences, and what lies ahead. Before continuing the video, press the like button and subscribe to our channel. Also, don't forget to turn on the notifications to never miss any of our upcoming videos. What triggered the avalanche? Silicon Valley Bank, SVB. So how did we find ourselves in this banking crisis? Well, it all boils down to one critical event: the downfall of Silicon Valley Bank. This state-chartered commercial bank was a prominent player in California, and in fact, held the title of being the largest bank in the world-renowned technology and innovation hub, Silicon Valley. SVB served as the go-to institution for tech startups, venture capital firms, and clients in fields like life science and healthcare. Notable entities such as Roku, Roblox, and Vox Media were among SVB's prominent associates. When SVB collapsed, it triggered a ripple effect that shook not only the banking industry in the United States, but also reverberated globally. So what exactly transpired at SVB, and how did it impact the rest of us? The tech industry has witnessed significant fluctuations in recent years, with Silicon Valley experiencing both incredible growth and sudden downturns. Unfortunately, this had a profound effect on Silicon Valley Bank, which was once riding high with around $100 billion in deposits. However, with interest rates reaching record lows, SVB's situation was already tenuous. Things took a turn for the worse when SVB invested billions in long-term U.S. Treasury bonds, assuming it was a secure bet, given that these bonds are backed by the government. However, much to their surprise, when interest rates began to rise, the value of these bonds plummeted swiftly, putting SVB in a precarious position. To exacerbate matters, the entire tech industry experienced a downward trend, prompting companies to withdraw their deposits en masse. This triggered a classic bank run, as panic spread rapidly, and everyone scrambled to retrieve their funds. It goes without saying that SVB found itself in an exceedingly gloomy predicament at this point. Clients continued to withdraw their money in large numbers, forcing SVB to sell off a significant portion of its bond holdings at a staggering loss of $1.8 billion. The situation turned from bad to dire as other investors and clients grew increasingly anxious about the bank's stability, leading them to withdraw even more funds in a state of panic. Astoundingly, on the day preceding the bank's ultimate collapse, clients withdrew an astonishing $42 billion in a single day. With massive losses and panicked withdrawals, it comes as no surprise that SVB's share value plunged by a staggering 60% in just a few days. This resulted in an astonishing $80 billion loss in the bank's shares value. The collapse of SVB was undeniably a catastrophic event, and its repercussions on the financial world cannot be overstated. What exactly led to SVB's downfall? There isn't a single reason that can be attributed to it. The pandemic wreaked havoc on the economy, and the issuance of stimulus checks contributed to significant inflation. In response, the Federal Reserve increased interest rates to combat rising prices. Higher rates make loans more expensive, dampening consumer demand and stabilizing prices. As a result, SVB's investments in long-term U.S. Treasury bonds from 2020 to 2021 took a hit with the higher interest rates. However, the blame game extends beyond the economic landscape. Politics also faces criticism. Senator Bernie Sanders accused former President Donald Trump and Congress of loosening some credit requirements established under the Dodd-Frank banking legislation introduced after the 2008 banking crisis. These requirements were intended to safeguard banks like SVB from collapse. Without them, SVB was left vulnerable. Adding to the challenges, SVB operated without a crucial chief risk officer for parts of 2022, which could have helped identify and mitigate investment risks. Speculations run wild, with shareholder lawsuit specialist Reed Catherine suggesting foul play and investor Danny Moses, who predicted the 2008 financial crisis, labeling it as complete and utter bad risk management on SVB's part. It's a combination of these factors that pushed SVB to the brink of collapse in the banking sector. Now the question arises, what steps will the federal government take to prevent a bank run? When the California Department of Financial Protection and Innovation officially closed down SVB on March 10, 2023, the FDIC, Federal Deposit Insurance Corporation, was appointed as the receiver. The FDIC acts as a personal insurance policy, similar to insuring your car or house. They provide insurance for your money in a bank, but up to a limit of $250,000 per account. So what about the tech startups with millions saved in their accounts and employee payrolls to cover? If the Federal Reserve didn't intervene, that money could have simply vanished or faced significant delays in being issued to those accounts. This would have posed a serious threat to people's livelihoods. However, the federal government stepped in as a white knight to protect its people. The FDIC established a new full-service, FDIC-operated bridge bank, allowing SVB clients to continue accessing their accounts. In a joint press release, following recommendations from the FDIC and the Federal Reserve, and after consulting with the President and Secretary Yellen, approved actions were taken to enable the FDIC to resolve Silicon Valley Bank in Santa Clara, California, fully protecting all depositors. Starting Monday, March 13th, depositors regained access to all of their money. The resolution of Silicon Valley Bank will not result in any losses borne by taxpayers. This intervention allowed SVB clients to resume normal banking activities, including online banking, accessing money through ATMs, using debit cards, and writing checks, just as they did before. A bridge bank refers to a nationally chartered bank that operates under a board appointed by the FDIC. It assumes the deposits, certain liabilities, and purchases specific assets of a failed bank. The purpose of a bridge bank is to bridge the gap between the bank's failure and the FDIC's efforts to stabilize the institution and implement an orderly resolution. While the FDIC protects SVB's depositors and ensures that none of their money will be lost, the same assurance cannot be extended to SVB shareholders and debt holders. In their joint statement, the three entities reassure the public that the U.S. banking system remains solid, thanks to reforms implemented after the 2008 financial crisis. However, the question arises as to the truth behind these assurances. Is the U.S. banking system genuinely remaining solid in the face of such a significant shock to the system? The collapse of SVB has had far-reaching consequences throughout the entire banking industry. While SVB was saved, it triggered a chain reaction within the financial sector. According to a study published by the Social Science Research Network, approximately 186 banks across the United States could face failure if half of their depositors swiftly withdrew their funds, similar to what occurred with SVB. Within just 3 days, we witnessed the collapse of 3 significant banks: SVB, Silvergate Capital, and Signature Bank. This banking crisis poses a significant economic risk and increases the likelihood of a recession. Goldman Sachs, a leading global investment banking firm, noted that the mounting stress in the banking sector has substantially raised the odds of a U.S. recession within the next 12 months, with the likelihood now at 35%, a 10% increase from before the crisis. On an individual level, this banking crisis will make obtaining loans from banks more challenging as they become stricter in their lending practices. Stressed banks are more cautious about lending and place greater emphasis on the creditworthiness of borrowers. According to U.S. Treasury Secretary Janet Yellen, we may witness credit becoming more expensive and less accessible. However, it's important to consider the actions that the Federal Reserve, Fed, will take with its monetary policy. Just a few weeks ago, Fed Chair Jerome Powell promised more aggressive rate hikes, But the banking crisis has altered the reality. It is now expected that the Fed will pause the rate hikes, potentially leading to a resurgence of inflation in the United States. Many experts within the banking and financial sectors have offered their opinions on the unfolding banking crisis. Chamath Palihapitiya, known as the King of SPACs, has issued a warning that the collapse of SVB could potentially trigger a significant event similar to the Lehman Brothers collapse, leading to the subsequent Great Recession. He predicts that without intervention from the Federal Reserve, there could be a run on regional banks that could spread to national banks. Palihapitiya suggests possible solutions to prevent another SVB-like collapse, such as deposit guarantees to prevent a massive bank run and the Federal Reserve guaranteeing troubled assets. He emphasizes the need for both federal and international regulators to step in to protect hundreds of startups and years of innovation from being destroyed. In contrast, Kevin O'Leary, also known as Mr. Wonderful, criticized SVB's management and expressed support for the Federal Reserve's intervention, despite having some of his savings tied up with the bank. Elon Musk, the world's richest man, compared SVB's failure to the Wall Street crash of the 1920s and warned of the potential impact on the world's largest economy. While the Federal Reserve did save SVB, questions remain about the long-term implications and whether this is a temporary solution for a potentially problematic economy. The collapse of SVB is not an isolated incident, but rather the first of many cases that could act as catalysts for other banks to fail due to various factors. The current banking crisis has far-reaching implications, affecting individuals, small businesses, and large companies, and further raises the likelihood of a recession. The situation is ongoing, and if the Federal Reserve continues with rate hikes and other banks follow suit, things may worsen before any improvement is seen. In conclusion, the state of failing banks has reached a critical juncture, raising concerns about a potential crisis worse than the 2008 meltdown. As we wrap up this revealing exploration, remember to stay informed and vigilant. The future of our banking system hangs in the balance. Press the like button if you found this helpful and comment to share your thoughts on this pressing issue. Also, don't forget to subscribe to our channel and turn on the notifications to never miss any of our upcoming videos. Together, let's navigate these uncertain times and strive for a resilient financial future. Thank you for joining us. And until next time, stay tuned for more insightful discussions.